So Dave, another topic around taxation, specifically around incentive stock options or ISOs. Talk a little bit about how ISOs are taxed.
Perfect. Thank you, Drew. So let's talk a little bit about the taxation of ISOs, and then we'll break down some of the tax strategy next. Before I jump into it, though, I think it's important to understand three specific terms that I'll use throughout this video, which are grant, exercise, and sale. Effectively, the grant is the price of the stock or the option at the time that company is granting that ISO to you. Exercise refers to the price of that stock when you actually exercise the option. And then sale is referring to you actually selling the stock after you turn it from an option into an actually owned equity position. That being said, I think it's important to understand this by going through an example. So let's say at the time the company offers the incentive stock option or grants the incentive stock option, the price of the stock is $50 per share. That is your grant price, because that is the price at which the company granted the stock. And let's suppose a year from today, that stock is now trading at $75 per share. The spread between the market value of the stock when you exercise the option, meaning you take it from just an option, you actually are buying the stock at the strike price of $50, that delta is considered for alternative minimum tax. There is no ordinary income on that, but it would be considered for the alternative minimum tax. Let's fast forward and suppose that after a certain number of years, you then sold the stock for $100 per share. That sale price in that example is what you would be taxed on when it comes to actually paying either ordinary income tax or more favorable long-term cap gains treatment. So let's talk a little bit about the strategies around this. Basically, to meet the holding period requirement to get the most favorable tax treatment, you would need to hold the stock for at least 1 year after you exercise the option and 2 years from the original grant date in order to qualify for long-term cap gains treatment. So I'm going to go back to the example that I was just giving, and let's break this down a little bit. If on December 31st, 2024, my company granted me 100 options at a strike price of $50, and on January 1st, 2026, I then exercised those options at a market value of $75 per share, that spread of $25 is what I would be paying potentially AMT tax on. But if I held the stock until January 1st of 2027, which is effectively 2 years after the original grant date and 1 year after I exercise the option, that spread is taxed at a long-term capital gains rate. So I think it's really important to understand this distinction, because oftentimes people don't fully appreciate the exercise date from the sale date being different. A lot of times we see people just holding on to these ISOs and not actually exercising them. These options may actually be in the money, but because they haven't exercised it, then oftentimes they are going to be taxed at ordinary income when they sell those. So be mindful of this. And if you're watching this and you want to understand this a little bit further, hop on our website at instrumentalwealth.com, schedule some time with one of our advisors. We'd love to have a deeper conversation with you around this if this is of interest.